Welcome to Retiring. Today we're going to reveal 5 common retirement income traps and how to avoid them. We'll cover not spending enough in retirement, overlooking the power of cash, not planning for longevity, mismanaging withdrawals, and underestimating inflation. We want to talk about the traps and how to avoid them so we can help you retire with confidence. Hi, I'm Molly Nelson here with Loren Merkle and Sean Honkamp. They're both certified financial fiduciaries and certified financial planners. Sean is also a CPA. Retirement income trap number 1, Loren, not spending enough in retirement. This might come as a surprise.
Who would have guessed?
I know this could come as a surprise to a lot of people, but really not spending enough in retirement can be a trap for some of those diligent savers.
It really can be, because the number one fear of most people going into retirement is, do you have enough? Are you going to run out of money before you run out of time? So thinking about, can I actually spend more, is not top of mind for most people. But this is where a lot of anxiety does come into play for people looking to retire, because there's a lot of questions that they have to answer that they've never had to answer before. So oftentimes this time frame should be the most exciting time, or one of the most exciting time frames of people's lives, where now they have all this free time. They can join the weekday card games with their retired friends. They can spend more meaningful time with their grandkids, travel more. They can do all these things, but yet it's steep with anxiety because of these questions that they have to answer. And that's why we say you get one shot to get retirement right.
It's a big mindset shift. They've been saving for a long time. It's really understandable, though, that some people, once they get there, they just don't want to spend. It's hard to turn it on. You talk to people in Retire Ready calls nearly every day. You sit down with people in those early visits, and you hear this a lot.
While people are saving leading up to retirement, you know there's going to be a day where you have to start those distributions and start spending those balances that you've accumulated. But even though once you get there, I've heard this all the time. People are telling me, like, Sean, it's different. It's scary now that we're actually doing it. People are so used to putting that money in, watching those balances increase, and that's that comfort. Now in this stage of life, we're going to start those distributions. Potentially, you're going to see those balances come down, at least in some accounts. But that's where having that plan is going to give you that confidence. It's okay to make sure people are spending a certain amount of money.
Okay, so not spending enough is the trap. The problem with the trap, Loren, is that sometimes people can end up with more money than they want at the end of retirement. They may work longer than they need to, and that's not what anyone wants either.
It's not what most people want. And over the last couple of years, we've helped people reclaim a few extra years of those go-go years just by helping them see how much money they can have if they spend X amount of money. It wasn't that long ago, an individual came in, we put her plan together, and as we were putting the plan together, we asked her, how much do you think you can spend to afford your lifestyle that you want and still not run out of money? And I remember she said about $4,200. She was 63, retired at 63. So we put the plan together, and at 63 at retirement, she could actually afford to spend about $5,200. But wait, it gets even better. A couple years later, at age 66, that $5,200 could increase to $6,500 a month. And then even a couple years later, because we do have to account for inflation because things do cost more later down the road, she could spend almost $8,000 a month with increases, annual increases with inflation, all the way going out to 100, and she didn't have to worry about running out of money. Talk about enjoying a few extra years of the go-go years with less anxiety. That is a really important aspect of planning, just by really narrowing in on your retirement income plan and figuring out all the other elements that go alongside that income plan.
And Loren got right to it. How to avoid this trap of not spending enough is to develop just what Loren talked about, and it's an income plan.
It's that clarity, it's that information about having an income plan. While you're working, the income plan is simple. We all give our week and that 40 plus hours a week to our employer. We get that known paycheck. The income plan in retirement, you're going to have to build that out of the guaranteed sources that you might have, meaning Social Security, potential pensions, and then filling in with distributions from all of the balances that any one plan has. And that's where that complexity, you've never had to do that before, and that's where you want to have that plan. Feel good about the decisions and the timing of turning on those guaranteed income sources, and then feel really good about the distributions that you're taking and that you need to cover the lifestyle that you're looking to have in retirement.
Yeah, I think that income plan gives people the confidence to spend in retirement. Let's get to trap number 2, overlooking the power of cash, and really overlooking the power of cash and how to use it effectively in retirement.
Yeah, and if you really incorporate an effective retirement plan, incorporating the income plan, the tax plan, the legacy plan, and all the other elements, cash can be so powerful in so many different ways. One of the ways to look at your cash is, and especially today when interest rates are a little bit higher, one way to look at your cash is your cash working for you the most positive way possible, meaning there's different types of cash. There's cash at the bank, there's cash in money markets, and cash at the bank right now might be giving you 1%, but cash in a money market, the right money market, might be giving you 4%. Still similar amounts of risk involved with those cash, still liquidity, it's just one's producing a higher rate of return. So which way is making your money work a little bit more for you? Well, the one that's producing 4. So we really have to look at different ways to use your cash, and that's just one example of how you can increase the efficiency of your cash.
Yeah, and I think overlooking the power of cash could happen to people that could fall into this trap because they get too focused on the investments in retirement.
That's what most people are doing while we're younger and we're working. The focus is primarily on that investment plan. You're putting that money in there, we're letting time go by, and it builds. It does require a little bit of a mindset shift when it comes to making investment decisions as you get into this stage of life. One of the realities is you don't necessarily need the top return on your entire portfolio at this stage of life. We've already said the word confidence and clarity a few times, I think, but most of you are looking for more of that confidence. The distributions that are going to be coming out, you may not want those dollars fully at risk in the markets. You need that diversification, and we need to shift away from just focusing on an investment plan, which would be this big, and shift that focus to a retirement plan, which is this big, because now there's 6 pillars to our retirement planning process.
And having some cash to incorporate in retirement can help lower some of the other retirement costs that are coming. I think about your Medicare premiums when I think about having cash to incorporate.
Yeah, I think it was last week that we built a plan for somebody who was a couple years prior to Medicare age. Medicare age for most people is age 65. And what Medicare does is the taxable income can influence the premium that you pay for your Medicare expenses. So using distributions from a taxable account like an IRA can increase the premiums you pay for Medicare. If you use cash, that does not go into that equation to influence your Medicare premiums, and that's exactly what we did with this individual. Let's use cash at this aspect of your retirement plan, and then it saves a little bit of room for some of the other tax planning like Roth conversions, and then your Medicare premiums also is not going to increase. So cash, because it's not a taxable income, can help even with the Medicare premium side.
And just real briefly, there could be somebody out there watching, maybe 57 or older, saying, hey, Sean, I don't have a lot of cash right now. If you start working on a plan to put some cash aside or put a cash somewhere now, then you can incorporate it when retirement time comes.
It's the nature of planning. More time you have to implement that plan, it's more years that you have to be aware of these types of strategies. And Loren, what you talked on, that's just one example where there's so much overlap as we manage the 6 areas of the plan. As we're making an income plan decision, it can be part of your investment plan and part of your healthcare plan. So we got to be aware of those opportunities so that over time, you might be able to increase and raise the amount of cash you have, which just provides more options and more control in those first few years of retirement and beyond throughout that retirement journey.
And we know that incorporating cash, how much cash, it's different for each person. Retirement looks different for everyone. So the questions that are on your mind are probably different from your coworkers or your neighbors. A great chance to talk about your retirement, your questions, is a Retire Ready call. You could schedule a Retire Ready call by going to retirereadycall.com. We've got 3 more retirement income traps to avoid next. Welcome back to Retiring Today. We're talking about 5 common retirement income traps and how to avoid them. We've covered not spending enough in retirement, overlooking the power of cash, and now we're going to talk about not planning for longevity. I'm Molly Nelson here with Loren Merkle and Sean Honkamp. Before we get to the trap and how to avoid that, first let's look at some of the latest facts from the Social Security Administration. Here's what we have. Life expectancy overall is increasing from 68 years in 1950 to 79.5 in 2024. So that's overall. 50% of couples reaching age 65 today will have one spouse that will live to at least 93. 1 in 3 people turning 65 today will reach their 90th birthday, and 1 in 7 will live to 95 plus. Okay, so those are the stats, but here's the big question, Sean. Why should people care?
Longevity is a really critical part of building that comprehensive retirement plan. The plan is driven by what you need from a monthly standpoint for your lifestyle, and then the big unknown of how long Are you going to need it? Because we talked about you don't want too much money left at the end of the day. Other people's spending decisions are not going to be the same as yours. So we need to be aware and think about what kind of lifestyle, how long of a retirement journey are people potentially going to have. The numbers are telling us that longevity is increasing. We fully expect longevity to continue to increase. And through a lot of the conversations we have, I think a lot of you assume that you probably aren't going to be around as long as what the averages are telling us. So it's kind of fun to go through that plan as we present it to people. We can show you at age 80 what things look like. And some of you might start laughing and saying, okay, that's about far enough. We can get to age 90 and even more of you are starting to say, okay, that's good. And then we go all the way out to 100. And a lot of people are saying, not worried about it at all, don't need to, but that's such a big unknown. So really, we've got to think about longevity because there's impacts with the inflation and just that continuous need. Because the reality is, if we live forever, we're all going to run out of money aside from those guaranteed sources. So we've got to be thinking about longevity, factor in the guaranteed sources we have along with the distributions from those balances to feel good about that long-term plan.
Well, no one's living forever that I know of right now, but I get your sentiment.
We're trending that way, though.
So here's the trap, though. If you don't plan for longevity, I'm just going to spell it out here. It is possible that you could run out of money in retirement. No one wants that, Loren.
It certainly is possible. In fact, I said that was the number one fear of a lot of people going into retirement. So yes, nobody wants that. And one of the scariest aspects of this is the last 3 to 5 years of your retirement could in fact be some of the most expensive years of your retirement due to health conditions and long-term care costs. So when we bake the long-term care cost potential into your overall plan, and when you're 85 years old until 90, you're spending $20,000 a month just on long-term care, that is really, really scary, which just fuels this anxiety that people already have about the potential of running out of money.
Okay, so I understand the trap. I understand that the numbers kind of present themselves to say this isn't something you can avoid. So how do I reduce the risk? We put a plan together, but let's get a little more specific now on some of the things that I know you help families and individuals work into their plan. You've talked a lot about the detailed income plan that goes out to age 100. By the way, do you guys get pushback on that sometimes? If people say, wait a minute, you're really going to draw me a plan to 100?
More times than not, I think. In fact, just last week, we built a plan out to 100, and I said, I don't want to live till age 100.
Right.
What else do you have? And that's part of the customization of this planning and a lot of the fun aspects. Okay, you don't want to plan for 100. You want to spend more up front in the go-go years. What do you feel comfortable planning to? Is it 95? Is it 90? And it can be a little different for everybody.
So that detailed income plan, that can help people plan for longevity, but there are also some tweaks you can make early on. So when you elect Social Security, maximizing that election can help make that money last a little bit longer too.
It's important to have a specific plan around electing Social Security. For a lot of people that don't have this plan, oftentimes you're treating that as just a single transaction or single decision to make, and you're not looking in the context of the overall plan. As we approach it, we want to know, we've got to look at the factors. For most of you, age 62 is the first time that you can even consider that decision. We get opportunities to defer and get that increase all the way to 70. So most of you, you're going to make that decision to elect Social Security between 62 and 70. And once you have the opportunity to, now you want to start analyzing the factors. What are the markets doing? But ultimately, at the end of the day, you want to feel really good about that Social Security decision because it has an inflationary component to it, which can help minimize that risk of longevity and living longer than you think or living forever. So we've got to feel good about that Social Security decision. The reality, the facts, the information tells us more people end up electing Social Security sooner than they should because you end up living longer than you think you're going to. And the longer you're going to live, the better off you are getting an increased benefit from Social Security, which means delaying that further into your 60s, potentially all the way out to age 70.
Loren, I also think if you can save money on taxes in retirement, then you'll have that much more to spend throughout your retirement.
The less money you send to the IRS, the more money you get to keep in your pockets, which means the more money you get to use to spend on your lifestyle. So the effective tax plan working with your income plan, you shouldn't have one or the other. You need to have both. And if you have both, then you can save more money and increase your spendable income potentially.
And for a lot of people, you build in some kind of a long-term care plan because we know that some 70%, I believe the latest stats are that some 70% of those who hit age 65 now will need some form of long-term care. So you help people build that into the plan as well.
Everybody should have a long-term care plan because it's going to impact almost everybody. What that plan could look different for everybody. And in fact, many people choose after they build their plan to self-insure their long-term care risk, but they choose to do that because they understand what that risk is, and if they need long-term care, how in fact they're going to be able to pay for that. And then of course, if they're married, how is the surviving spouse and their retirement going to be impacted by a long-term care event as well. But if you choose not to self-insure, there are many other avenues you could use to offset some of that long-term care risk. But the number one thing you should be thinking about is, how do you incorporate that long-term care plan into your overall plan?
We've got more retirement income traps to avoid next. Welcome back to Retiring Today. We're talking about 5 common retirement income traps to avoid. So far, we've covered not spending enough in retirement, overlooking the power of cash, not planning for longevity, and now it's time for trap number 4, mismanaging withdrawals. I'm Molly Nelson here with Loren Merkle and Sean Honkamp, and this can be a problem for several reasons. Let's go over the first one. It can be a problem if you mismanage withdrawals because you could pay more in taxes than you anticipate in retirement.
You could pay more in taxes if you've done a good job in creating some tax diversification, but yet in your withdrawal strategy, you don't work that diversification into it. Then you could be taking withdrawals, paying more tax than what you should, and that could have a whole array of implications to your overall retirement plan.
Yeah, if you start taking money out of those taxable accounts first, you bump yourself into a higher tax bracket, then you're like, wait a minute, I should have maybe gone through other accounts. That's kind of how that could be mismanaged,
yeah,
correct?
Maybe you should have used some cash. That could have been an effective way in your position to use some cash. Because you're taking too high taxable withdrawals, it could increase your Medicare premiums, and you could potentially run out of money sooner than later because you're paying too much in tax and not putting enough towards your lifestyle.
Yeah, it's a problem because of all 3 of those reasons. Taxes can deplete your income, and you could trigger higher Medicare premiums. But how to avoid it? That's what everybody wants to know. So one of the ways to avoid it is to have a tax-efficient income strategy.
Yeah, but if you've got those tax diversified buckets built, as you build this distribution and withdrawal strategy, you've got to be thinking about those and now take advantage of them. If you're doing it on your own, you very well might just turn on and start taking money out of that pre-tax IRA and let it sail on forever. But once you make a decision on that distribution strategy, now you've got to monitor and pay attention to the factors. What are the markets doing? Are there tax law changes? And be able to adjust, be ready to adjust at some future point and make changes to that distribution strategy. So be aware of the different buckets. Think about taxes as you're taking income and then making distributions, and just be aware and be ready to make changes as needed.
All right, he said be aware of the tax-efficient buckets. Guess what? At home, Sean, I don't have 3 tax-efficient buckets in my garage. So, Loren, what does he mean by tax-efficient buckets?
What he means is you have different types of money that when you take money out is going to be taxed differently. So cash is taxed differently than your pre-tax IRAs and 401k plans, and your pre-tax IRAs and 401k plans are taxed differently than your Roth IRAs and Roth 401k plans. But you might have these different buckets, and if you don't, that might be a part of your overall tax plan too, is how do you create some of those buckets to create more tax efficiencies. But that's what we're talking about when we talk about these 3 different buckets.
Oh, we're not hauling around buckets of money in retirement. That's not how it works?
Not
Some
preferably,
people, but not very common.
Okay, so if that's something you want to dive into more, that'd be a great opportunity in a Retire Ready call. You could talk about the buckets. If you don't feel like maybe you have that tax diversification now, it's probably not too late to. That's something a retirement planner could definitely help you out with. Okay, let's get to trap number 5. Underestimating inflation. Boy, this really ties in with a lot of the things we've been talking about, especially longevity as well, because longevity and inflation are so closely tied together. Why is it a problem, Loren, if people underestimate inflation in retirement?
Because we do know that what your lifestyle that you have right now is going to cost you, even if you keep the exact same lifestyle, which most people don't, but if you do, 10 years from now, that lifestyle is going to cost you more. So if you do not have an effective inflation beating plan as a part of your overall income and retirement plan, you're going to wake up one day down the road and you'll be like, I cannot have the same lifestyle for the same amount of spend. What did I do wrong? And it's at that point in time that you're going to have less options to fix that problem. So you might as well focus on it prior to going into retirement when you construct your plan, so you don't have to wake up one day and say, whoops, I forgot to account for inflation and now my lifestyle is sacrificed because of it.
And inflation on things like groceries and cars and houses is one thing, but we know that the inflation on medical costs actually usually is sometimes double what the inflation on goods and services. So you have to also think about those later years of retirement when you might be spending more on your medical costs than you ever had before.
Yeah, there's a challenge just planning for inflation alone, let alone thinking about this big category, which that whole health arena can have a big impact on the plan. That's one of the areas that can really take your expenses and lifestyle from here to here rather quickly. That is kind of an unknown. But yeah, the healthcare expenses are increasing at a higher rate. So yeah, while we're thinking and planning for inflation for your basic lifestyle and your basic goods, that's part of your plan. And now we've got to be prepared for that potential stage of life where healthcare expenses come in. And as you said, the inflation level on those are even greater, and that can have a real big impact on the long-term plan.
Okay, so that's the trap, not planning for inflation. We want to avoid the trap. How do you help people when you help them build plans?
Well, one of the ways is we have to incorporate inflation into the plan from day one. So we use an assumed inflation rate and say over the course of the next 20 to 25 years, this is how much you're going to need to increase your spending over that time frame to account for inflation. Then we also look at other pillars of your plan. We look at the tax plan. If you can send less to the IRS, you can keep more in your overall portfolio. And as it grows, you're going to have more growth because you have less of a tax bill. And then we also look at the required minimum distribution age, because it's been a while since I've said this on this program, this phrase, the tax ticking time bomb. This is referring to that time that you are mandated to take distributions from your pre-tax accounts. And now all of those distributions are subject to federal tax, which is on top of your Social Security income, if you have a pension, your pension income, and any other taxable income you have. And if you don't have an adequate plan for that, then that can increase your overall tax bill. And for some people, it can increase the overall tax bill for the entire retirement experience. So planning for the required minimum distributions can be an effective way to overcome this inflation battle as well.
I also think about investments. So if someone's spending about $5,000 a month now, and you think about inflation, it might be $15,000 a month in 10 to 15, 20 years. They're probably thinking, I'm not going to have that amount of money. Well, you also have to think about investing with inflation in mind.
There's a portion of that portfolio that we've still got to take that risk. You're likely to have some of your retirement balances in the markets at risk, no matter what age or how old you are. But you want to feel good about that proper diversification. Let's make sure we're taking the appropriate amount of risk, but let's make sure we have some of your assets positioned to outpace inflation. Let's get the really strong returns when the markets are positive, but maybe not have the entire portfolio at risk of when we have those down markets.
And we've done a good job, guys, of talking about the traps and how to avoid them, but people probably have questions. A Retire Ready call is a great place to start.
One of the hardest parts about creating a retirement plan is just getting started. And that's what I really like about the Retire Ready call. It's a very simple way for you to get started to create your retirement plan, and you get answers to the questions that you've been thinking about. We're talking about a lot of anxiety that goes into retirement. Let's diminish the anxiety, get started with your plan with a Retire Ready call.
You can schedule a Retire Ready call at retirereadycall.com. This is Retiring Today, and we thank you for watching.
Thanks for watching. If you liked this video, click here for more great content from our team. Don't forget to subscribe to continue to receive helpful information for your retirement planning.